The Asian markets have kicked off the first trading session in 2016 on a negative note. Energy-related stocks, though, they're doing pretty well on the back of a bounce that we're seeing in crude prices.
My sense is we may not get away with this kind of cut because the cuts are real in the Asian markets. And anyway, we've seen a bit of a rally for our market, so there's a good chance that there would be temptation to book some profit. There would be a bit of a fear factor as well because of the way the Asian markets have fallen.
Well, there goes the bell, and it is a 0.5% down tick, 7922, but far from the Lakshman Rekha of 7990.
Chinese market, as we told you, the market trading has been halted for the entire day. There was a halt that took place for 15 minutes after the index fell more than 5%, but now we understand the stock market has fallen 7% and trading has been halted for the entire day.
Now we're approaching the 7,800 mark. 150 points gone on the Nifty. The Sensex is down closer to about 500 points. The advanced decline ratio, which had opened up in favor of more stocks in the green rather than in the red, is now completely reversed.
With that, we come to an end of what has been a really disappointing session for the bulls, that is. The Sensex closing with a loss of 540 points and the Nifty down almost 200.
Well, not a good start to the year 2016 for equity markets. We had quite a bit of decline in all markets led by China, and today there was a bit of a fear factor. So that's why we're calling it China the Fear Factor. I'm Anuj Singhal, and with me Sonia. Hi Sonia, good evening.
Hi Anuj, what a tough day of trade it's been. Any way you cut it, there's been disappointments for the bulls, whether it was the frontliners, whether it was the mid-caps, and all of this on really high volumes, and we closed at the lowest point, so there was no respite at all through the day.
Yeah, I think I'll tell you what, today was, as the show itself says, today was the return of the fear factor, Sonia, because after a long time we've seen something like this. We saw this, I think, in August and September, but for the market to fall the way it did in today's trade, that was telling you that it was really, the panic or fear factor, which was again clearly gripping the market. And all of this on back of very high volumes. The cash volumes in particular, the F&O volumes were extremely high. And if you look at the Nifty futures, or if you look at the options data, the kind of selling that we saw and the kind of put premium surge that we saw at 7,500, 7,600 was telling you that this was a market in which there was quite a bit of fear. Not just that, there was not one single stock which contributed more than 10% to Nifty's decline. You had an HDFC that contributed 17 points, but the Nifty was down 170 points, and so many stocks contributed to the market decline. So all in all, a really bad day. The bigger question is, was this a one-off? That's something that we'll find out.
Oh yes, and if you talk about individual stocks as well, there was a lot of large cap pressure that came in today, whether it was like the HDFC, Infosys, Reliance. So whichever way you cut it, today was a weak day. But these are all the top headlines that we're tracking. The market nosedives on weak global cues, loses over 2%. The Nifty closes below 7,800, and the Sensex sheds over 500 points. Banking and telecom stocks drag today.
Mid-cap suffer, but not nearly as much. The mid-cap index ends 0.8% lower, dragged down by big reversals in high-beta mid-caps.
And the Shanghai index plunges 7%, spurring a trading halt for the session after the factory activity shrinks for the 10th straight month, reviving concerns over the durability of the economic recovery. Rest of Asia too ends with deep cuts today.
Tata Motors takes it on the chin, slips over 6%. The company gets 15% of its sales from the Chinese market. Tire stocks too react negatively as China devalues the yuan, making Chinese tires cheaper.
And crude prices pared their gains after earlier jumping over 2% on rising tensions between the Middle Eastern rivals Saudi Arabia and Iran.
Well, the top theme today, of course, was the ripples of fear from China spooking investors in India. China's market manufacturing PMI has contracted further, leading to weakness in the yuan and in turn prompting a 7% fall in the Shanghai composite. In fact, circuit breakers had to kick in and halt market trading as a result.
All right, we will discuss that main theme on the show in the next half an hour. So first up, we have Nilesh Shah of Kotak Asset Management, and next we have Robert Parker of Credit Suisse, who will join in to make sense of the mayhem in China and assess the impact for Indian investors. Let's quickly start with the markets itself. India was not immune to the rout that we saw in China. So let's invite Nilesh Shah, in fact, to tell us about what he believes could be the way forward. Nilesh, hi, good evening, and thanks for joining us. It was a really disappointing start and it came out of nowhere. Of course, these China problems have been talked about for a while, but today we saw a damage of more than 500 points in one shot. How did you read into this, and would you get spooked now?
See, definitely China is one factor which we have to watch out for. And clearly today for the Global Emerging Market Fund, India is still part of the BRICS. We need to differentiate ourselves vis-a-vis China. The ultimate investor, when he's seeing headline that Chinese economy is slowing down or Chinese economy has problems of debt, he probably loses confidence across Brazil, Russia, China, India altogether. They are seeing headlines which are not conducive from Brazil as well as Russia as well as China, and whatever positive headlines we make probably is not making impact on them, and which is why we are seeing selling pressure. But this selling pressure in turn creates an opportunity if we can market ourselves well. Within the BRICS, B, R and C are crumbling, but I can stand apart, I can stand out, and hopefully should result into collection of more flows from investors away from Brazil, Russia and China.
Nilesh, hi. So we are getting into bad company, right? I mean, BRICS was a good term 5 years back, not anymore. Time to take eye out of this and maybe get into some other group.
I think instead of going into other group, if we stand on our own and if we can demonstrate to the world that here we have made companies like Maruti which has grown bigger than their parents and we have given decent return to investors, probably we will get differentiated vis-a-vis the emerging markets. And in fact, we have differentiated ourselves vis-a-vis emerging markets in last 3 years where we have delivered positive return whereas emerging market is negative. So this last 3 years track record should be highlighted more to create a differentiation.
Sure, that point is taken. Now on a more serious note then, Nilesh, the story of 2015 was, especially the second half, FI outflows and a lot of domestic money flowing in through the mutual funds and insurance companies. Do you think that's at risk now, especially if our markets go back and break the previous low at the index level? Do you see that kind of panic then resulting in the domestic flows also slowing down?
We have plan A and plan B over here. So let's talk about plan A, which is the domestic flows. Now typically in the fourth quarter of financial year, we always receive more flows from the insurance. They get almost 35 to 40% of their business in that quarter, and traditionally in the Jan to March quarter, insurance have been bigger buyers of equities. My presumption is that this quarter should be no different from last quarter. Now if the equity market continues to fall, certainly there will be an impact or slowdown in the domestic flows. Last year mutual fund invested more than 72,000 crore into equity markets, and certainly they haven't met the expected return. So if they foresee that there will be more volatility or downside in the market, probably the intensity of this flow will slow down a little bit. It will not reverse for sure, but certainly there could be a potential slowdown if our markets fail to deliver expected return to the investors.
So what would your advice be to a lot of the retail investors or long-term investors who are watching this screen now, Nilesh? What should the equity allocation strategy or asset allocation strategy be for an average investor in 2016?
For the passive investor, we have been recommending and we will still recommend SIP into multi-cap and large-cap funds. Yes, markets will be volatile, they'll go up and down, but whatever is happening in China, whatever is happening in rest of the emerging market, in some sense is positive for India over medium to long term. The Chinese slowdown will lower the commodity prices even more. We are net importer of commodities, so eventually we will benefit from this correction. If we see the oil price correction itself, we would have probably saved about $70 to $80 billion from the top of the oil price correction. And if India was a company and we would have saved that $80 billion and we multiply that with whatever P ratio, you can imagine, a significant value creation happening. So to the retail investors, my recommendation will be, if you're a passive investor, please do SIP and don't worry about the volatility. Keep the faith on India growth story. If you are active investor, then you can follow asset allocation strategy depending upon your views on different asset classes as well as your portfolio. So either be an SIP investor or follow asset allocation depending upon your asset portfolio and view on the market.
Nilesh, if I were to play the devil's advocate to your argument, again, for India as a company, we haven't done much in terms of, having investor confidence in terms of, say, top-line growth. We've seen this earnings, the anemic earnings recovery continue all through the last year. There's a chance that that's going to continue for 2 or 3 quarters. So why should an investor choose a market like India over any other market?
Absolutely, Anuj, you are absolutely right in saying that in last 12 months we haven't shown any definitive earnings growth. However, let's make some concession from at least a positive point of view. A lot of our earnings growth is negative because PSU banks are providing for NPS. These NPS weren't created last year. They were created over many years but are now being provided for. We also saw some of one-off events in pharmaceutical sectors which has resulted into earnings getting down in those sectors. If I take this kind of one-off events in pharma sector, in banking sector, and also a little bit of commodity sector out, because there we have seen an exceptionally lower prices, then the rest of the economy is still delivering about 8 to 10% earnings growth, which is nothing exceptional. But there is 8 to 10% earnings growth coming in non-commodity sector, non-PSU banks, one-off events in pharma sector, which in today's scenario where your nominal GDP is lower than real GDP is reasonably okay. More importantly, we are building a foundation. Today we have fiscal deficit which is under control, we have trade deficit which is under control, we have inflation which is under control, we have room to cut interest rates, our currency has been remarkably stable vis-a-vis our peers. So on a macro point of view, we have created foundation. Yes, it has taken 12-24 months to build that foundation, but if you now give time, hopefully we will build a bigger building than Burj Al Khalifa.
Okay, well, we hope so. That we've been very patient. That's not played out just yet, but hope springs eternal, right? Just for the very near term, Nilesh, how high is the possibility of India or Indian markets being at the start of a prolonged cyclical bear phase in an otherwise structural bull market?
I don't think so. We should be using this correction to define bear market. Bear markets are probably those markets where the prices are correcting because fundamentals are not in place, because valuations have become expensive. In India's case, we are at a valuation which is about 15.5 times. Now, if market corrects, valuation will become even cheaper. That's not the bear market. That's actually the beginning of the bull market, because more smart money will come to buy at those attractive valuations. The second thing is market cap to GDP ratio. I mean, today we are trading a market cap to GDP ratio of roughly about 60%. That's not very expensive. So I don't subscribe to this theory of bear market. Yes, in calendar year 2015 we haven't delivered return expected by the investors, but you take 2 years horizon and we have still delivered 20% plus return, which is not bad. Equity market can be linked to Chinese economy or Chinese concepts in one manner, that most equity markets are like bamboo tree. You keep on watering for 4 years and nothing happens, and then the 5th year bamboo tree goes and touches the sky. In equity market, the only difference vis-a-vis bamboo tree is that you don't know which is the 5th year, which is the year in which markets will give return. Could it be 1st year? Could it be 5th year?
Okay, you're talking a lot about bamboo tree, Burj Khalifa, Nilesh. So maybe expecting some big heights for Indian markets as well in 2016. But the bigger problem, or one of the big problems for our market, Nilesh, has been that the market hasn't got leadership from the two big sectors, banking and IT. Banking, in fact, even private sector banks seeing one of the worst runs that we have seen in some times, especially the leadership stocks. And even IT has not done much. Where do you think the leadership will come? Because at the end of the day, while mid-cap story is fine, the index needs to move.
Absolutely, Anuj. The leadership, unfortunately, is happening from an economic point of view into unlisted space. We have seen e-com companies creating billion-dollar plus market cap. Now, unless until those companies comes into the listed space, the leadership may not come into the index. The second thing is related to within index, private sector banks, material companies, they should be able to provide the leadership. We have also seen fair amount of underperformance in, certain petrochemical company, petrochemical giant. Now, possibly there could be an opportunity over there as well. My feeling is that like calendar year 2015, 2016 will be year of stock-specific returns. The returns might be available outside of index rather than within the index, and that is why we have seen mutual funds delivering 4 to 8% outperformance over benchmark indices, and the same trend should continue in calendar year 2016 as well.
Okay, we love your eternal optimism even when the markets are turbulent, Nilesh, and we liked all of your analogies today as well. You have a good day. Thanks so much for joining us and giving us your views. So that's one market expert on the global cues and the kind of impact that India might see because of the situation in China. We'll do one thing, we'll take a break, but still ahead, Robert Parker of Credit Suisse will join in with his take on the Chinese crisis.